Now, this circle right here, and a lot of people, when they are creating wealth, they don't understand the wealth transfer part, right? When you're transferring wealth, this is what you call opportunity cost. It's not just you're not just losing a dollar. So let's, for example, you lost a dollar. You're not just losing a dollar, but you're also losing what that dollar could have earned for you. If we could have put that dollar somewhere where it's earning 5%, the next year you'll make 105, and the year after that you make 110 and 115 and 120, and so on. So you're not like just using the dollar, but you're also losing what that dollar could have earned for you, how that dollar could have worked for you. That's what you call opportunity cost. So whenever we talk about wealth transfers and opportunity cost, this is the biggest areas where you're going to have the most wealth transfers, right? Your mortgage. An example of your mortgage, I mean, think about it this way. If you have a mortgage and whether you're paying extra money for your mortgage, or you have a 15-year mortgage, you have a 30-year mortgage, or an ARM, there's so many different products out there that the banks have. So my question for you is, which product is making the bank the most money, right? And which product is saving you the most money? Because if the bank is making the same money on every single product, then there would only be one product. So this is what most people don't understand. We have to look at this part and see where the leaks are. Because if there's a way to where you can make more money, right, or you can save more money in your mortgage, we can redirect that. Taxes, again, we talked about this earlier. State tax, that's about to change in 2025 as we're making this video. The the limit on state tax is changing, and there's a lot of money that's going to get transferred here if you're not ready for this, right? Especially for the people that are making 15 million, 20 million and up. Income tax, property taxes. We look at all this stuff, right? How you are paying for taxes and where are the places we can save you in taxes. Qualified plans. For example, your 401k, is it better to pay a maximum amount for you? Max out your 401k. Is it better to just pay the match? There's certain ways to where we can contribute to those plans and figure out different ways to where the money can be in a better environment. Because what you think about with qualified plans, all that is just you're postponing the taxes. And we have clients that are getting to that retirement age, and when you're pulling a certain amount, that means your Social Security might get taxed. All of that stuff, we have to look at that so that we can move the money in an efficient way, so that whenever we pull it out, we're pulling it out to where Uncle Sam is just going to tax the minimum amount, right? Because if we pull it out in a way to where he's going to get a larger amount, then why would you want to do that? So we have to put in an environment to where we're underneath the radar of Uncle Sam. Protection. When we're talking about this, one of the things here that we look at is like different ways you're paying for insurance, right? For example, if you have a very low deductible on a car and a very, very high monthly payment, what if we can give you a higher deductible and lower your monthly payment, right? And then put that money somewhere where it's earning money for you. And then if you ever need it, I always ask people, when is the last time you've been in an accident? Never been in an accident. So why do you have a low deductible? We can redirect that money, put it somewhere where if you need that money, you have full access to it. And you can pay that deductible if it's higher. But your money is here earning money for you, okay? That's one way. And then, of course, term insurance, long-term care, there's a lot of stuff here that we can look at. College planning, another big piece. We can look at that as well. And this is where the main for most people, this is where major leaks are happening. Interest in credit card, financing a car. And I'll show you this because we always end up reverting to this financing a car because it's the most basic thing and everybody does it. Okay, so financing a car. When we're looking at this, when you're financing a car, most people, they'll see the interest, right? They see the interest, the principal, but they don't see the opportunity cost. And this is why the car companies love finance, because most people don't see this. And an example would be, what is a basic car price right now? 50, 60 grand, let's just say $60,000 car at 6% interest rate calculated for 5 years. That's $9,000 that you gave away on interest. You gave that to to the car company, to their financing department, or if you have a loan to the bank, to a credit union, you gave that to them, okay? When you give that to them, what if we could put that money somewhere where it's earning 6% for you? If there's a way to redirect that money, instead of you giving it to them, you keep that and you put that somewhere where it's earning 6%, what would it look like? That's what it would look like. In 50 years, $176,000 that you lost in opportunity cost. If you're let's say you're 30 years old and you have another 35 years of buying cars, that's 73,000 that you lost in opportunity cost. If you are buying one car every 5 years, that's $250,000 that you lost in opportunity cost. Would you like a check for $250,000 in your pocket in your golden years? Absolutely. Nobody's going to say no to that, okay? So if every 5 years you're buying a car and you could have put that money somewhere where it's earning 6% for you, that's $250,000 that you're losing. And this is only one person. Think about it this way. If you have a husband or a wife, if you have 3-4 kids, how much it's over $1 million in opportunity costs that you're giving away unknowingly and unnecessarily. The reason why car makers love financing, okay? That's just to show you the numbers.